Good morning. Welcome, everyone. Thank you so much for making time to attend this webinar. Before we begin, I'd like you to please read this marketing disclaimer. Thank you. A quick reminder that all participants will be on mute during the webinar, but we do welcome your questions using the Q&A function throughout the session. My name is Swati Jain, and I'm the Global Head of Sales and Distribution at HOODinar. I'm joined by my colleague, Gaurav Narain, who's based in Mumbai. Hi, Gaurav. And he's the portfolio manager of the India Capital Growth Fund, the investment trust from HOODinar Asset Management, which focuses on the small and mid-cap stocks in the listed Indian equities space. HOODinar, as many of you would already know, is a boutique asset manager based in London and Mumbai, investing in Indian equities, and we do so via two flagship funds, a UCITS multi-cap fund called Gateway to India, and an LSE-listed investment trust called India Capital Growth Fund. Both our portfolio managers and our in-house research and analyst team are based locally in Mumbai. Gaurav himself has been managing monies for over 2 decades and has delivered almost 14% per annum in GBP terms in this fund since 2011. Coming to the India growth story, I don't think the India growth story needs any introduction, but there are a few fundamental changes that place India now in the enviable position of not just being a long-term investment opportunity, but a more opportunistic near-term one. To set the scene, if we compare the UK and the Indian economies, India has a very large young demographic, 600 million, with rising disposable incomes. The economies are similar in size, but with the distinction that India is set to grow at a much faster rate. Why is it then that there has been foreign investors have taken out bucketloads of money over the last 6 to 8 months? Gaurav, I'd like you to maybe talk to us about why have foreign investors been taken money out of India and what impact has that had on the markets?
Sure, thank you, Swati. I think it's quite true. India's seen a flood of outflows over this last, ever since October. In fact, this chart which you see in front of you, the blue line is showing the sort of outflows we've seen since January. And during the January to July period, we actually saw almost $28 billion of outflows. I have not seen such strong outflows in such a short period of time. And one can only believe it's largely risk off, which is happening. But I would like to highlight the more interesting point is, if you see the gray line on top, that is the sort of inflows which are coming into the domestic equity mutual funds. And that's more than offset the outflows. In fact, in the same period from Jan to July, the mutual funds have seen almost $32 billion of inflows come in. Now, it's very difficult to take a call on how the foreign flows will play out because it's really driven a lot by global factors. I'm comfortable on seeing the sustainability of the domestic flows. Now, why do we say that? And to answer that, really, I have this very interesting chart in front of you. This is a chart which is showing the net inflows in domestic equity funds from what I call systematic investment plans. These are money being, every month you're seeing is inflows coming in from retail investors. These are small ticket item amounts coming in from investors in tier 3-4 towns of India. And the interesting aspect is that this chart shows the inflows from January 17 onwards. And what you'll notice is since the last 4 years, every month there's been a net inflow of $1 billion or more into domestic mutual funds through just these systematic investment plans. Now, why we are confident of this sustaining is that even when the markets corrected ever since the Russia-Ukraine war happened, the inflows have only increased. So it gives us a lot of confidence that, the domestic flows are really balancing, quite a counterbalancing aspect. And this is really one of the big reasons why we are actually seeing that the Indian markets have really performed much better than its global peers. In fact, it's been one of the better performing markets. And we're fairly confident that, I would say the volatility caused by foreign flows, inflows and outflows has reduced tremendously in the Indian markets.
So there's a steady hand that has emerged and which you feel that's here to stay.
That's correct.
So maybe I'd like to ask you a bit about oil because most of us are aware that India imports a fair bit of its oil. In fact, India is probably the third largest crude oil importer. Presumably, the oil touching record highs has wreaked havoc on the currency. Maybe throw a bit of light on that.
Sure, I think that's true. India is dependent on oil. 85% of our oil is imported. In fact, 30% of our entire import bill is due to oil. And last year, our oil imports in absolute value itself was about $165 billion. And that's just going to climb going forward. And given that the economy is growing, our oil import bill is going to is not going to come down for one. The result of this is that there's always a drain of forex currencies when oil prices shoot up. And the impact on that is on the currency, which tends to depreciate very aggressively whenever there's a global problem. But I would say two things have changed in these last few years, which really mitigate the problem on the currency. And the first is what you see in this chart below. The gray bars are showing the value of oil imports over the last decade. But the interesting graph is that of the blue bar, which is the exports of IT services out of India. And what you'll notice is that IT services exports today are higher than the oil import bill for the country. Which is really a big mitigating factor that the forex inflows coming in from IT exports is more than offsetting the outflows due to oil imports. That's a very big change on the forex side. The second aspect is also on this chart is showing the foreign direct investment flows into the country. This is long-term capital coming into the country. And this is steady flows, which really does not see much volatility. What you're seeing is from an average annual inflows of about $30 to $40 billion, since 2015 has actually steadily been moving up. And today they're averaging about $70 to $80 billion of inflows. So both factors have really, what they've done is that today from on the foreign currency account, from a balance of flow deficit, we are actually, our foreign exchange reserves have been rising. And this is reflected in this chart, which is how the currency has behaved over almost a 20-year time frame. The red circles really show how in any global event which has happened, India's currency is typically depreciated by 20 to 30% in that period. This time it's different. And if you see the extreme right bar, our currency is depreciated about 7% from Jain onwards in this year, which is really reflecting the strength of the macro environment. In fact, today, India is sitting on foreign currency reserves of about $565 billion, which is the fourth highest reserves anywhere in the world. So really, it's provided a big push into the country, and it's being reflected in the currency behavior.
Do you think that this behavior will continue, that it will still be steady, or is there going? Do you feel that this trend can continue of the Indian currency being more stable than before?
Yeah, my sense is that one should just assume that the currency will depreciate 3 to 4% on an annual basis. And this is largely assuming that the interest rate differential between the US and India. The difference now is that earlier it used to be very volatile. You'd have periods of very sharp depreciation. Today, with the sort of reserves we have, I think that will be mitigated. The volatility will definitely come down.
Okay. I think the other pain point that we have faced across the world is high inflation. Presumably, India has also had the same issue. Has the government or the central bank taken any measures to rake it in?
Yeah, so inflation is a challenge across the world, and that's true in India also. However, so in this chart, I've really shown India's inflation versus the developed markets, and the dark blue line is how inflation in India has panned out. And I'd like to highlight 2 points. The first is in India today, as you can see in the circle, inflation is now under control. In fact, inflation has been declining for 3 successive months. Today, it stands at 6.7%, but is expected to trend closer towards 6% by the end of the year. The second point is, if you again look at the graph, India has historically had high inflation. In fact, in the pre-2014 era, it used to be at 8 to 9%. And since 2015, our Reserve Bank of India chose targeted inflation fighting as its primary goal. So since then, you've seen inflation come off. What I'd really like to highlight is that today in India, unlike what you're seeing in the West, it's not creating any panic. I would say people are used to higher inflation. We are not seeing any impact on demand. Companies have raised prices, but there's no real impact on demand. On your question of how the government is fighting it, I think the central bank has raised interest rates by 140 basis points to 5.4%. We expect them to go up by another 60 basis points. The government, on the other hand, has been quite proactive on fighting inflation. One is for India, we are a food surplus country. So all they did was first ban export of food items, which really brought your food inflation down. On the oil side, the government, when oil prices collapsed during COVID, what the government did was they actually raised duties. So the retail prices actually did not fall in line with oil prices. And when oil prices started trending back upwards, the government actually unwound those duties. And after a point, they actually capped retail prices also. So the hit was taken to a large extent by some of the oil marketing companies. Also, the government's been playing around with the duties on imports and exports to try and mitigate the forex impact due to this as well. So I would say they've handled it quite well.
So what I'm hearing is it's more or less imported inflation and food inflation. What about wage inflation?
I don't think India is facing any question of wage inflation. It's in a few pockets, primarily in the IT services sector, because of the huge demand the sector's seen, and to some extent in financial services. But inflation wage inflation is not an issue in India.
Okay. You talked a bit about what the government has done to rake inflation in. So on the topic of government, most of us know that the Modi government is famous for its reform agenda. It's announced quite big bang reforms like demonetization and implement the GST. Are there any other big bang reforms that the government has announced or is due to announce?
I would say the big ticket reforms are all done. Now it's all about execution. In fact, the focus of the government is really on driving growth. And they're doing this through two means. At its own end, they are spending very big on infrastructure. And this chart is highlighting the gray bar showing what the central government, how its investments in the infrastructure space itself has shot up. From what was about $50 billion a year, today they're spending almost $200 billion on just building out infrastructure. So that's from the government end trying to drive growth. And on the other hand, on the corporate side, they've come up with several schemes to bring back manufacturing in India. They're trying to capitalize on the China plus one trend on supply chain diversification. And they've really identified 15 different industries where India is a very large market or has competitive strengths, where they've provided incentives for companies to start manufacturing. And the incentive is almost $35 billion worth. And in several sectors, the ones you see in the gray, production has already started. The one in the blue, the capex phase is on. But you're seeing quite a big change already happen on the ground. Capex cycles have improved in the manufacturing space. Credit growth in the banking system has picked up to 15%. If you speak with some of the capital goods companies, their order books are at record highs. So really, there's a lot of activity happening on the ground on the growth.
And is this activity translating into, corporate India as well? Are you seeing any growth in the earnings? We've heard a lot about how the earnings will finally kick in India. Any input on that?
Sure. I think one way of looking at it is if you just look straight at the GDP growth forecast. And this is the IMF forecast for different, all large economies. And you'll see that India is right on top. They're forecasting about 7.4% growth this year for India. And even the next year, it's 6% plus. It's way above even China growth rates. And this is actually factoring in the slowdown you're seeing across the globe. When we speak with managements, or even when you're seeing all the high frequency data points, you're finding most of them showing a very healthy trend. And I'd like to just highlight one or two data points which give a very broad perspective of what's happening in the economy. This graph here shows the indirect tax collection, which is the goods and services tax on a month-on-month basis. And I've compared it, what the tax collections are on a monthly basis versus the pre-COVID days. And what you'll find is that current tax collections on an average on a monthly basis are trending almost 40% higher than pre-COVID levels. This is a very strong representative of the sort of growth companies are seeing on the sales side. A second chart, this one is putting down in India, every time a truck leaves a factory, it generates what is called an e-way bill, which is tracked by the government. And this bar shows on an average how many bills are being generated each day for the month. And it's really representative of the movement of goods within the country. And in this also, you'll see that it's actually tracking almost 30% above the pre-COVID days. And I'm insisting on pre-COVID because, that was a normal period before and a normal period after. So really, I would say almost all parameters which you're seeing, India is really showing a fairly healthy trend on the growth side.
So maybe if I can do a quick summary, what you've said is that the structural growth story in India remains intact. There is a strong domestic buyer that has emerged and seems to be here to stay. Inflation is calming down, and policymakers are in any case very skilled at handling much higher levels of inflation. Reforms continue to be implemented and corporate earnings are picking up as well. So all in all, it seems like India's story at a macro level stacks up pretty well. So I'd like to maybe switch the conversation now to how we give investors access to this growth story. So as a quick reminder, we at Ocean Dial are bottom-up active managers. Just because a stock is in the benchmark doesn't mean that we're going to put it in the portfolio or own it. We have a very high active share, around 90%, and we run a concentrated portfolio of 30 to 35 stocks with a very low turnover. We are mid and small cap focused, but within that, we buy industry leaders and usually hold the stocks for a long term. You'll see that over 60% of the portfolio has been held for over 5 years on average. We are focused on the quality of the management and the fundamentals of the business when we construct the portfolio. I'd like maybe, Gaurav, for you to talk to us about, you earlier in the conversation, you mentioned, for example, that with oil touching record highs, the oil companies have taken a hit. Have you made any tactical changes to the portfolio, especially in terms of sector positioning, bearing in mind high oil, high inflation? I know you mentioned that inflation hasn't had any effect on demand, but I'd like you to talk to us a bit about the sector positioning, any tactical changes you've made in the portfolio.
Sure. So Swati, in a nutshell, this is a slide representing our portfolio, both in terms of our sectoral positioning and how it's placed within the mid and small cap space. What I'd like to highlight first is on the table. If you see the first row in the circled red circles, what is interesting is the earnings growth of the portfolio. It's really 34% in this current financial year and 29% in the next financial year. This is really reflecting the growth we're talking about in the Indian economy. So really what we're talking about is actually flowing into the corporate earnings side also. There is a bit of a base impact which comes into play because of COVID, but the fact is you're seeing a lot of momentum in the economy. Coming to your question on how we've positioned our portfolio, what we've really done is today our largest exposure is in the financial sector space because this is where we are seeing the real play happening on the earnings growth overall. I mentioned credit growth is already up at 15%, and banks are, I would say, one of the few sectors where you're seeing them trading still well below the historical averages. A second change we've done is within our consumer sector, which is where we get a lot of our compounders, we've switched more towards the consumer discretionary plays from pure staple companies, because we're also seeing a very strong revival in the real estate sector, and these are all de facto plays on it. So it's a very bottom-up driven portfolio, but I would say still fairly growth focused. but it's really capturing most segments of the economy where we see the growth happening. To put it in another perspective, this slide, we've really classified our portfolio into four buckets. But I would really highlight that, the portfolio is fairly growth biased, and where we've added a lot of the new stocks are in the high growth phase. It's really capturing the market. It's fairly concentrated as a portfolio. And as you mentioned, that we typically buy with the intent of holding companies from a 3 to 5 year perspective at least. So they're good quality businesses, and we try and hold them and let them compound over time. Having said that, I did mention that we do play in the mid and small cap space, but mid and small cap does not mean you're going down on the quality curve. In fact, what this slide is representing is really that what we are really buying are industry leaders. They're either dominant players, they're leaders, or they're very niche businesses, which give them a lot of competitive edge. So, which is where we are fairly confident that even in periods of high volatility, the earnings growth will play out over a period of time.
Thank you, Gaurav. I'm going to pause here. I've had a fair number of questions that have popped up. So thank you to all our participants for sending them through. I've tried to club these under various heads. So if I cannot pick up your question during the session, I will get in touch with you later to answer it. The first question, Gaurav, is that you've spoken about the sector positioning. The question is, do you take any tactical bets on the market cap as well as between mid and small and large cap?
I think our portfolio is very bottom-up driven. So we look at it from a very stock perspective area. So we really don't go on a tactical market cap position. We are very focused that the company should be able to deliver sustainable long-term earnings.
Okay. There's a question on bond yields, that what are your views on the impact of bond yields on domestic investment flows? And is there a level where you think these will get sufficiently attractive to domestic savers that it impacts equity flows?
Well, I think so far we've not really seen too much impact, really. Having said that, if you take a household savings, it's about 20% of GDP. 50% of this is in financial savings. A lot of savings is in physical assets like gold and real estate. The savings which go into equities is just about 5%. In fact, it was much lower at about 2%. So you're actually seeing a trend in shift in savings moving out of physical assets into financial assets, which is largely due to, I would say, education. And also that the reforms have made it more the cash economy is also drying up. So I would say, the opportunity of money flowing into both equity and debt is high. And what we've actually seen over the period, it's not just money's moved into equities, but money's also moved into the deposits. So both areas have been seeing a lot of flows of money. And I don't think bond yields will really have too much of an impact on flows into equities.
Another question that has come through is on timing, that couple of participants feel that investing in India, despite whatever we hear, is a timing story. It is a long-term play, no doubt, but the investors need to continually swing in and out to ensure good returns.
Well, I think that's true for every market. But having said that, I have a chart here which reflects how India has performed over long-term periods. And the rows highlighted in light blue give you how India has performed both on the mid-cap and the Sensex over 10, 15, and 20 years. And you'll see that India has really been one of the best performing markets compared to its peers. In fact, it's really giving the US market, which has had such a great run, a run for its money. And the reason behind this is that India is actually a high growth story. So even if you take a 30, 40 year period, our nominal GDP has grown at around 15 to 18%. So, that's the sort of growth we've seen. And I would say after all the reforms we've seen, we're also entering another good growth phase going forward. So timing is slightly difficult. But from a portfolio perspective, what we also do is we within our stocks, we do reposition our weights. And this slide here highlights a stock we've owned. It's a company called PI Industries. We've owned it for over a decade now. And over a period of time, this company has delivered earnings growth of almost 20% per annum. This is an agrochemical company in this space. But as it's grown and people have got more comfort in its financials, you're finding that the stock has re-rated. And we've really consciously, whenever we find the stock moves into excessive valuation zones, we take some profit and play with our weights. But as long as the long-term growth story is still fairly intact, we really ride with the business. So we are tactical in that sense that we do, within our existing holders, we're just not sitting tight. We are shifting weights around a lot based on the valuations, excesses or corrections.
The next question is on ESG. 12 months ago, all manager presentations focused on ESG. Many have changed their focus or are more silent on this subject since markets have been more volatile this year. What is your position, and are you still investing in your ESG processes?
Yes, I think we are very focused on ESG, and we've done a lot of homework, and we look at ESG from a risk mitigation perspective. And we're very conscious that any company which does not meet our corporate governance standards or is lax on environment, on the social side, we just do not include it in our universe itself. So what we have is, as an investment process, we have a house of HOODinar, which is a universe of about 145 stocks, which have to meet all the criteria on ESG. So we have a negative list, and we're very clear that for us, ESG is a part of our process. It's a risk mitigation strategy, and we're very clear we will not digress from that. It has affected us in our performance to some extent, because if you see the stocks which have really done really well over this last year in India have been some of the defense companies and sort of some industry groups which we did not touch because of governance issues.
Gaurav, I'm going to take two questions on market valuations now. So the first question is that Indian markets have been trading at a premium for a long while. What are the valuations now? Have they eased off, and do you see them continuing?
Yeah, I have one chart. So I think what's happened with India is it had got very expensive, and then post the correction, it had come back to historical averages. But I would say the recent run in the last month and a half has again got it maybe 5 to 6% above historical averages. In the chart, the central line, which is the gray line, is what we call the historical average multiples for the market. Having said that, India has outperformed most of its peers. So from a relative perspective, India's actually got even more expensive. So if you look at it from broad shell, you'll find India is not cheap. But having said that, I think two things would stand out. First is India's historically always traded at a premium to its peers. And that's because of the nature of the market, that the return on equity has always been higher than other markets. It's a very diversified market and not a commodity driven market. So the components are very, very different. So structurally, it's at a higher premium. And the second is the growth is also very high. I mean, I think we are entering a fairly high growth phase and driven a lot by what's happening in the domestic economy. So while we are concerned on what's happening globally, I think the domestic reform-led changes have now reached into the growth phase.
I'm going to digress a bit. There's an interesting question on a couple of questions on the Russian-India relationship. Can you maybe talk to us about how the Russia-India relationship has affected flows, market sentiment, import-export relationship overall?
Well, I think, India has very strong historical ties, which date back to the Cold War days. And the reason was that, the US was siding with Pakistan ever since the 1974 war we had with Pakistan. Hence, by default, India sided with Russia. And a challenge with Russia is that most of our military hardware is of Russian origin. Now, post the Cold War, in fact, in the last decade, India has structurally been moving out of Russian defense equipment. In fact, I would say today 60% of the hardware would be of Russian origin. But in the last decade, most of the sophisticated hardware we bought is from the Western economies and Israel. So our dependence is definitely reducing a lot on the Russian economy, but there's a lot of historical ties. And today, in the current Ukraine-Russia crisis, India cannot afford to have a situation where Russia cuts off the spare parts, etc., for some of our military hardware. So that said, strategically, I think the government has played its cards very well. It's actually been able to explain its position to the Western world on why it's not voted against Russia. And on the other hand, India has actually got a lot of negative press because from buying virtually no oil from Russia, we used to buy about 1 or 2% of our oil requirement from Russia. We've actually increased that, and today about 12% of our oil requirements is being bought from Russia. But diplomatically, I think the government has done a good job. They've actually been talking to the Western world, and most governments have kind of agreed with what India is doing. In fact, India is becoming very strategic for the Western world because of China on a border. And we have now entered a new agreement with, they've created another bloc with Japan, Australia, the US to take on the Chinese. So I think the relationships with the West have been increasing fairly dramatically. And I think India has managed its balancing act fairly well, I would say.
Maybe a last question, and this is a cheeky one. So if you had to invest an incremental pound of your personal wealth, where would your largest allocation be? And please do not say India.
Well, you're asking India specialist who's talking very bullishly about how he's seeing the Indian economy to invest elsewhere. But I'd really want to leave you with one slide to give you a perspective of India and why it's difficult to talk about investing elsewhere. This is a slide by the World Bank showing how over several decades, economies have been moving in terms of where they're positioned on the global scale and ranking. The bright orange line is India. And what you see is virtually every decade it's moved up the ranks. And I'm not sure if many of you have read this, but last week the IMF came out with the quarterly GDP data, and India has overtaken the UK to be the fifth largest economy in the world. And in the next decade, it's projected to be the third largest economy in the world. So, this is really reflecting of the longer term picture of where India is heading. And to top it up, if you see the per capita income, I think Swati started with that first slide on 600 million people. The per capita income of India is still just about $2,000. So all the growth that you see will really pour straight into consumption, because the incremental money earned is not going to go into long-term saving, but it's really first going to go into consumption. So it's a very I think attractive opportunity I see going forward, and for a very long period of time.
Thank you, Gaurav. On that note, I'm going to end this webinar and thank all the participants for making time for us. Should you have any questions, please feel free to reach out to either David or myself. Our details are on the screen now.
Thank you.
Thank you.